Right. Thanks for that. Before we get into
Listening live to Fed Chair Jay Powell in a conversation at the U.S. Monetary Forum
about where you think the framework is going to land. It was nice to hear the parameters that you laid out, but is there anything more that you can say beyond what you just?
Sure. So I said there are two things really. There's changes to the consensus statement, and they're looking at really our post-meeting communications. We're going to look at those two things a lot. And as it relates to the consensus statement, which is also known as the Statement on Longer Run Goals and Monetary Policy.
Okay, 570.
We are going to be looking a lot at the changes that we made in 2020. So if you go back to 2020, what we had was we'd been at the effective lower bound for 7 years. We never got rates above 2%. We were at 1.5% when the pandemic hit. And the feeling very much was that if even a mild downturn came, we'd be back to the effective lower bound, maybe again for years on end. So we were looking for ways to try to minimize the likelihood of that. And a pretty standard result in the research was a kind of a makeup strategy. That's what that was. So the framework changes that we made were very focused on the importance of the effective lower bound problem, which was thought to be the big problem at the time. And those were the changes that we made. So, and we thought that those things, that those issues would be persistent, but the universe had other ideas. And the pandemic arrived just a few months after we implemented the framework and really changed the whole mixture. And effectively the idea of an overshoot, of a modest overshoot or moderate overshoot of inflation really became irrelevant. And we were back to the regular framework, and we did what we did, and you have the results today. So I think we'll be looking at, for example, the focus in the consensus statement. We'll be looking at the focus that we had on the effective lower bound. It's probably not the base case anymore, but it's probably still relevant. We'll be looking at shortfalls, which is an interesting idea, but then there are different ways to express that. And we'll be certainly we'll also be looking at the idea of having a moderate overshoot of inflation over the 2% target following periods when inflation has been low. We're looking at all of those things, and again, I expect to be done, by the end of the summer. On the communications, particularly our post-meeting communications, we're going to take a close look at the SEP and also compare ourselves to what other central banks around the world do. And this will be a couple of weeks from now. We'll have our second meeting, and I think we'll be done in time for sort of the end of the summer.
Okay, that's great. Let me pick up on this question about the level of prices versus the inflation rate. Economists spend a lot of time making the distinction between the rate of change and the level. I'm not sure that the public fully understands this because you see these surveys about how frustrated people are with inflation. Inflation now is not that different than your target. It's above, but not meaningfully so. But do you think that price stability needs to take into account how far you wear away from the objective? And if you've had a big run up and the level remains high, even if the inflation rate is back to normal, is that something we need to reconsider?
The public experiences is the prices of things. And the prices of things went up a lot in 2021 and 22, and to some extent in 23. And when we talk about inflation, we're obviously talking about the rate of change now. But the public's not wrong. They are experiencing high prices, and obviously you can have a great labor market, but if people are really struggling because of high prices, that's what they're really going to feel. So they're right about what they're saying.